Here's the brutal truth. You don't need to be a genius to invest. You don't need a degree in economics. You don't even need to know statistics or be an MIT graduate. What you really need is the ability to keep emotions in check and follow a few simple rules. And if you can do that, you'll do just fine. Here's what I used to get wrong about investing when I first started. I thought it's complicated because that's how it's sold to me. Financial advisors use fancy terms. TV shows make it look like rocket science, and everyone acts like you need some secret formula to succeed. But the truth is, Warren Buffett, the best investor in history, follows 3 simple rules that anyone can understand. I'm going to share those 3 rules with you today. They're so straightforward, you might think I'm leaving something out. But here's the thing about investing. It rewards discipline, not complexity. And these 3 rules have created more wealth than any complicated strategy ever will. If you want a simple place to practice these rules, I recommend signing up for the broker I use, eToro. I put the link in the description. You can buy fractional shares and set up recurring buys without the drama. The first rule sounds almost too simple. It's what Warren Buffett calls your circle of competence. It's a fancy way of saying, stick to what you know. If you can't explain how a company makes money in plain language, don't own the stock. If the business sounds like a puzzle designed by a board game designer on an afternoon bender, that's a red flag. Think about the companies you interact with every day. You probably use an iPhone, drink Coca-Cola, shop at Walmart, or eat at McDonald's. These are businesses you understand because you're their customer. You know why people buy their products and whether those products are any good. Now compare that to some biotech company developing a drug you can't pronounce for a disease you've never heard of. You have no idea if their research will work, how long it takes to get approval, or whether anyone will actually buy their product. That's not investing. That's gambling. Here's a simple test. If you can't explain the business to your 10-year-old cousin in under 2 minutes, you shouldn't own it. Take a company like Coca-Cola. They make drinks that people love and buy every day around the world. Simple, right? Now compare that to some complex biotechnology company developing experimental treatments you can't even pronounce. Which one makes more sense for your first investment? This isn't about being lazy or avoiding growth. It's about playing to your strengths. Maybe you work in retail and understand how stores operate. Maybe you love technology and get how apps make money. Maybe you're into healthcare and know what makes hospitals successful. Start there. Your everyday experience is actually a massive advantage that Wall Street professionals don't have. When you invest in businesses you understand, you'll know when something important changes. If you own a restaurant chain and you notice their locations are always empty, that's a red flag. If you own Apple stock and everyone you know is switching to Android, you might want to pay attention. But if you own some complicated tech company and you don't even know what they do, you'll never see problems coming. The best part about staying in your lane is that you don't need to know everything about everything. There are thousands of companies out there, but you only need to find a handful that you really get. Those businesses might not be exciting, but they're often the best investments. This brings us to rule number 2, and this one separates the winners from everyone else. Think long-term, not next week. Our world has trained us to want everything instantly. Food delivered in 30 minutes, movies streamed immediately, messages responded to within seconds. But wealth building works on a completely different timeline. Here's a mind-blowing fact. If you invested $10,000 in the stock market and left it alone for 30 years, it would likely grow to over $100,000. Assuming average market returns. But here's the catch. Most people can't leave it alone. They check prices daily, panic when they drop, celebrate when they rise, and make terrible decisions based on emotions. The stock market goes up and down every single day. Sometimes for good reasons, sometimes for no reason at all. If you let those daily movements control your decisions, you'll drive yourself crazy and lose money. A great company doesn't suddenly become terrible because its stock dropped 5% today. Similarly, a struggling company doesn't magically become wonderful because its stock jumped 10%. Imagine you owned a pizza shop. Would you sell it because someone walked by and shouted out a random price that was lower than you thought it was worth? Of course not. You'd focus on whether the pizza shop was making money. whether customers kept coming back, and whether it would be worth more in 5 years than it is today. That's exactly how you should think about stocks. The daily price is not important. What matters is whether you own a piece of a good business that will be more valuable over time. Here's what long-term really means in practice. When you buy a stock, imagine you're buying the entire business and you can't sell it for 10 years. Would you still want to own it? If the answer is no, then it's not a good investment for any time frame. If the answer is yes, then short-term price movements shouldn't bother you. The compound effect is what makes long-term thinking so powerful. It's not just your original investment growing, it's the growth on top of growth, year after year. Small amounts invested consistently over long periods become large amounts. It's not exciting or flashy, but it's incredibly effective. The earlier you start and the longer you wait, the more powerful this becomes. That's why time, not timing, is your best friend in investing. And speaking of timing, here's rule number 3 I learned from Warren Buffett and that I stand by to this day. This rule will keep you in the game long enough to actually build wealth. Avoid unnecessary risks. Notice I didn't say avoid all risks. I said avoid unnecessary ones. There's a huge difference, and understanding it could save your financial future. Never invest money you can't afford to lose. Never borrow money to invest. And never put all your money into one stock, no matter how confident you feel. Trust me, if you want to start the right way and dodge the rookie traps, try eToro. I put the link in the description. It is an easy-to-use platform, very beginner-friendly, and the commissions are some of the lowest. Use it to buy fractional shares, set tiny recurring buys, or even mirror conservative traders so you can learn while you build without touching your emergency fund. I recommend starting with a demo account first until you learn how everything works. People get into trouble when they see investing as a shortcut to make a quick buck and get rich overnight. They hear about someone who made 50% in a month and they want that too. So they take money from their emergency fund, or they use credit cards, or they put their entire life savings into one sure thing. This is how people get wiped out. The stock market will go down sometimes. Individual stocks will disappoint you. Even the best investors are wrong 30 or 40% of the time. If you're risking money you need for rent or groceries, one bad decision can ruin everything. Here's a simple test. Ask yourself, if this investment goes to zero, will it affect my ability to pay rent, buy food, or handle emergencies? If the answer is yes, then you're risking money you can't afford to lose. Only invest money that you won't need for at least 5 years, preferably 10 or more. The most dangerous emotion in investing is greed. It makes you throw caution to the wind and chase returns that seem too good to be true. If someone promises you guaranteed high returns with no risk, run away. If it sounds too good to be true, it probably is. Remember, there's no free lunch in investing. Fear is equally dangerous because it makes you sell at the worst possible times. When markets crash and prices plummet, fear tells you to sell everything and hide under your bed. But that's often when the best buying opportunities appear. Companies you've wanted to own suddenly become available at discount prices. When you do invest, spread your money across different companies. Don't put more than 5 or 10% into any single stock. I don't care how much you love the company or how sure you are it's going to succeed. Diversification is insurance against being completely wrong. Remember, you can't go broke if you don't owe anyone money, but you can lose everything if you take on debt and the market turns against you. The goal isn't to get rich quick. The goal is to build wealth steadily over time without taking risks that could knock you out of the game completely. These 3 rules might seem simple and easy to follow, but they're useless if you don't have a step-by-step plan to buy your first stock and invest your first dollar in the stock market. So go watch this video next where I show you exactly what I would do if I started investing in 2026.